Welcome back to another episode of Give Me Some Truth. Friday afternoon, I'm in the booth with Keith and Syl. This is Nate, for those of you that are listening. Recent market events.
Very quickly, do we still call it a booth?
Well, I read that it's actually a good call. It's probably more of a room, if you will, a
salon.
Sure, if you will, sure.
A nod to Syl's French room.
Absolutely.
It is a market salon.
It's a place where we're going to figure out some answers to what's going on in the markets today, or at least be able to try to help people frame mentally what's happening and maybe thinking about it in a little different way. So the kind of the premise that we're going off of today is the idea of timing the market versus time in the market. Relatively large distinction between those two ideas. I'll start with Syl. Syl, you and I talked a little bit before we hit the record button here. Kind of give a little bit of a brief synopsis in terms of our logic behind the idea of timing the market versus time in the market, and maybe why that's applicable to what's going on today.
Sure. I mean, and there's quite a lot to this discussion, but at a really basic fundamental level, it's the better way to invest, right? The reason we tell people to stay invested is not because we are dogmatic about it. It's just because we think it's going to be better long term, because we think it's the way to make money in markets long term. There's a lot of data really that supports this idea, right? So you can slice it and dice it a number of different ways, but the message is always the same, and it's that it is better in the long term to remain invested. And yes, that is also true of difficult periods of the market, spikes in volatility, and everything else. If you look back historically, buy and hold strategies have done a lot better. The way to make money long term in markets is to remain invested and be there when the market has this really great day or 2 days, or that really great week when all of that risk is finally being rewarded,
and potentially in the midst of a significant downturn overall. Right.
Absolutely.
These days can happen.
Absolutely.
Somewhat unannounced.
And these days, these really strong market days tend to happen. They tend to cluster around these periods of really high volatility, just like we're in right now. So it's this idea that with chaos comes, opportunities, and you just have to be there for that. Right. That's a big part of it. And you and I were talking before this podcast about the kind of data that looks at market returns over a really long period of time. And then, so I think there's some really good data from JP Morgan, for example, that shows that if you were invested for 20 years in a broad index like the S&P 500, you would have something like a 9.5% average return during that period of time. But if you missed just the best 5 or 10 market days, your returns would be just half of that. That is literally how important it is to just capture the big upswings in markets. And like you just said, they tend to happen in periods of really high volatility. They tend to happen when there's a lot of chaos, a lot of back and forth, a lot of uncertainty. And so that's the really hard part, is to see the uncertainty as something that will also eventually be a source of opportunity. And I think a lot of people tend to underestimate the extent to which market returns are concentrated around really short periods of time.
Right.
Is we all tend to think about our portfolios and say, okay, I'm supposed to get 5% a year at least from my portfolio. And so we see a 10 or 15 or 20% downturn, and we're like, oh my God, I won't be able to retire, or it's just, terrible things are going to happen. But the reality is risk is not rewarded evenly over time.
Sure.
And you could absolutely achieve very strong long-term returns even while exposing yourself to that occasional, sell off. And so it's a bit of a mental exercise to remind yourself of the importance of staying the course.
Sure.
Because we all have a tendency to want to react, and it's just normal. And we all feel it here. You see the news flow, you see volatility, and you feel an urge to act, to do something. And oftentimes that can be a source of mistakes.
Sure.
Because if you change course, if you sell, then you put yourself in a very difficult situation, because now you have to start timing the market, and it's a different game. Because once you sell, you have to time your sell orders right. So you have to sell at the right time. And then if you want to get back in, then you have to be right again. So selling and re-entering means that you have to get it right not once, but twice.
Right.
And that's extremely difficult.
And as well in taxable accounts, right? You're handing the house 15% in capital gains in many cases, right? And so then further you have to get it right because you're
realizing that.
Yeah.
Mm-hmm. Yeah, right.
And so I think, you're even further in the hole there. Right?
Absolutely. Once you include taxes and trading costs, it's even harder to keep up while trading.
Keith, what's your reaction to that idea? Time in the market, timing the market? I mean, what kind of first blush reaction to that idea?
I would say in some sense it's the conversation that we have about everything that we do, right? Finance is kind of governed on time in the market, timing the market. One of the things that I repeat often, and I think the time in the market should also relate to where you are in your life, right? We're using it as staying in the market, right? But if you're, 30, 35, one of those old things that when financial advisors get together and we tell bad jokes and that sort of thing, we always say is, the stock market is the only thing that people don't want to buy when it's on sale.
I said that today.
Yep. And so, it's a financial advisor cliche, I think, probably at this point. But the point being is, if you're in the accumulation phase of your life, right, you want to be buying now. You don't want to be running away. And fortunately, we have things in place to force that buying discipline on you.
Right.
In terms of regular 401k contributions and so on and so forth. But from the bigger picture is, thinking about making sure that you stick to a regular contribution plan. You stick to that plan. Right. You don't try to think that you're smarter than the market by not buying now, because this is when you want to buy, right? Especially if you're in the accumulation phase. And then the other thing that I think, time in the market, people often go, where they are in their lifestyle, in their life stage. Well, in many cases, we know that if you're drawing on your funds, we want to give you a cushion and a buffer. And, so you want to have different asset classes. Now, and chances are, if you've gone through a plan, your advisor knows that it's not going to always go up 40% and, year over year, or that it's not going to just be a steady 9.5% return. So they've also prepared for, this is your time in the market. Yeah, we're going to be selling some of it, but we're not selling everything.
I think that's a great point. Let me jump in just a second. I think that where there's misconception in a lot of cases is, especially if you're drawing down assets or if you're living on your investments, is, well, I'm drawing on my assets, therefore, whatever my portfolio is down rate of return wise, I'm losing that every time I take out a withdrawal, right? And missing the concept that we as advisors can pick and choose which asset classes we're selling out of and drawing money out of to facilitate distributions. And therefore, we don't necessarily have to be selling an investment that has lost money, even though your overall portfolio rate of return might be negative, right? There might be pockets of your portfolio that have actually held the line or potentially even done well in down markets. And so therefore, it kind of goes back to the idea of a well-diversified plan so that we're afforded the ability to pull from an asset class that isn't necessarily down as much as the market is down.
Yeah, and I think, and Syl, we've, on the international side, we see this as well. Not everything is as poor year to date as the U.S. markets are. I'm thinking Asian markets have held up fairly well year to date relative to the U.S. And so I think it's also getting that perspective of, getting away from that idea of just being one market.
Yes, right. And understanding that your portfolio is if done correctly, excuse me, right? It's a grocery cart of investments, right? It is not all picked from the same area of the grocery store, if you will. It has a myriad of different investments within it, and it's done so for a reason. And right now in the market is the reason why we have that, right? So you and I were talking earlier as well about the idea that, I don't know that people fully understand the concept of timing the market, or maybe wouldn't necessarily label themselves as market timers, because I think in some cases it's easier for people to say, well, I don't day trade, so I'm not a market timer, or I'm not a stock trader, if you will, therefore I'm not a market timer. And I think you and I talked about the idea that, kind of, if you will, everyday investors can trip themselves into the area of market timing, even though they don't define themselves as market timers.
Right? Sure. Yeah, absolutely. I think there's many ways that you could engage in excessive market timing in a way. You could just think about trying to cut risk, for example, when you see a lot of volatility. So stay invested, but not stick to the plan, not stick to a long-term strategic allocation. And
so let me jump in. Syl's a CFA, so let me just define what that means for the non-CFA people. Taking your portfolio and making it less risky. There.
Exactly.
Right.
Oh, right. I thought you were going to define CFA and just say Syl is much better. I mean, on the technical side of discussing investments,
it doesn't need to be said. I mean, I think that's clear already.
Well,
I mean,
we're dropping in the folksy wisdom, right? We're like,
right, exactly.
The grocery cart.
We understand the rank, if you will, in the office of designation.
Yeah.
CFA being, the one that wears the crown.
Yeah.
Sorry, continue.
No, that's my cue to stop talking. It sounds like I've already said too much.
he gets to use the fancy words.
He does.
Yeah, and he's going to start talking about 2 standard deviations.
Exactly, clicks and whatnot.
No,
but in all seriousness, right? We talk about people saying, the idea of literally, right? I want the pain to stop.
Yeah.
Right. Mm-hmm. And so therefore, kind of complete the sentence. Well, anything that comes after that might as well just be labeled as market timing, right? At
Absolutely.
that point.
It's really tempting to try to cut risk, try to reduce your equity allocation and all of that.
Right.
But that's not necessarily the right thing to do, right? And again, that is being reactive. That is trying to time the market. And it comes with a lot of risks, right? So,
which is interesting, right? So the idea of cutting risk, right? Comes with a lot of risks.
Absolutely.
And I don't know that necessarily is understood correctly either.
Absolutely. And going back to what I was saying earlier about having to get it right twice, obviously, now you could decide to go to cash or buy just short-term treasuries or short-term bonds because stocks are selling off and interest rates are going up, for example. Very, very logical, reasonable position to be taking. At the same time, you're exposing yourself to risks, right? Because who knows what might happen in the coming quarters and months and years, right? And so you could find yourself in a situation where you've made that shift in your portfolio only to find that the market then goes up 20%. And you find yourself then, chasing that rally and reinvesting after the market's gone up 20%. And that's when it tanks another 10% when you just reinvested, right?
Right. I think what's interesting is, and Keith, I want you to kind of run with this idea. March of 09, right, was more or less the bottom of the 08, 09 ugliness. And there were people that were selling out hand over fist at that time and may still not be reinvested
Yep.
14 years later, right?
Yep. And yeah, we've talked to them, we've seen them, and they're the people that will, say, well, we've just never had really good luck with the market.
Right.
And, you have to think through the longer term and think, your house price, well, now with things like Zillow and so on, maybe you can get that, but your house, a lot of people becomes a great store of value because it becomes a set it and forget it. You pay your mortgage automatically every month. You accumulate the equity. You do that. You don't think, oh, my house value went down $500 last month.
Right.
I'm not going to put any money into my house, or my house appreciated. I'm going to put double the money into my house now, right? It's a nice steady. And I think investing, in the markets, we get, because of their liquid, because you can pull the money in and out so easily, we don't necessarily mentally approach them in the same manner, which is, keep calm, stick to the plan. What I do want to stress is as well, what we see frequently is the flip side of this eliminating risk, right? Is when things are going well, people are taking more risk, right? And so one of the conversations we often have with people is, well, we want to buy a house in 6 months. What should we invest this in? Right. It's going to go up for sure in 6 months.
Right.
Because when the market's going up, people just think, oh, it's going to keep going up. Well, in that 6 month period, for the year, it might go up 9%. But the smaller you shrink that period, the higher chance that you're going to have, the opposite of that big up day. You could have that big down day before you close on your house, and nobody wants that, right? You don't want to have to be, digging through your piggy bank to take money to your closing, right?
Yeah, and I want to be clear too for the people that are listening that in this conversation, the risk that's involved, the scariness of the market, what's happening right now, we're not being flippant. We're not dismissing it as saying the fears aren't real, or that people that it's not scary. It is. We absolutely respect that, and we're not telling people to not be frustrated or angry about the results of the market recently. We completely get it. I think it's just more of understanding that during these times is when you absolutely need to rely on your advisor to help get you through, because these are the times where people tend to make more emotional decisions, which in a lot of cases can unfortunately not be founded in kind of objective, kind of well thought out decisions, and it can be a little bit more of a reactionary decision, which in a lot of cases I think can lead to just unfortunately bad results.
Yeah, and I think what we should stress, right, is my feeling is the best investors, the ones that have done the best over time, right, have a couple of things that they rely on, and one of them is a plan, and they stick to it, right, and that they believe in their plan. And yeah, it's really easy to, and we all have it. I think when the market is up, 10% year to date, it's an easier time to do our job. It's easier to convince people to take risk off the table in those environments than it is to put it on in certain cases right now, right?
Right.
And so I think, from our perspective, we're not trying to minimize it. What we're really trying to do is say, hey, step back, because what often happens in these situations is you feel like the world is closing in on you. And I think Syl has done a good job of making the case that, hey, let's draw back the curtain. Let's not let it get all locked in on us. Let's look at the big picture again.
Right, because, and I think the stat, I think it still holds true. It did a number of years ago, but the averages will show us that the market is up 7 out of every 10 years, somewhere in that neighborhood, right? And so if we just think about it just from a sheer number standpoint, if every 10 years, we have 7 pluses and 3 minuses on average, we would obviously rather be on the 7+ years side of it than the 3 negative years. But I think the trickiest part is understanding that nobody sends us an email or gives us a call when we're going to have one of those 3 years.
All right. Absolutely. I mean, there's there's been a lot of very valid reasons to sell over the last, several decades. And at the end of the day, for a patient, long-term investor, it would have always made sense to stay invested, right? So you have to play the percentages, and you have to give yourself the best possible chance to win. And, the way to do that is just to remain invested, even when things are tough, even when there's a lot of volatility. Like you said, there's even investors who will take the opportunity to add more, the opportunity to buy. And that's very hard to do. But the way markets work, almost by definition, is that the best time to buy is when it makes you physically sick to just even think about buying.
Right.
That's just how it is, because the bottom comes when all hope is gone.
Right.
That's literally how it works.
And I think and I think part of the reason for that, right, is that just from a psychological standpoint, we as humans, we're built, and they've proven this, that we're built to put more emphasis on pain, negative, whatever it might be. I think it's almost literally twice, however they measure that, but we feel twice as much pain when we go through that than we do euphoria when things are going well, right? And I think that goes all the way back to the idea that, obviously if you touch the fire, it's going to burn your hands, so probably don't do that again. And so I think it's easier for people to say, well, I've been through this before and it didn't turn out well, and so I'm not going to make that mistake again, as opposed to realizing that if we just push through these times, we get out the other side, right? I mean, think about the last, 15 years. We had, the last 20 years, right? Tech bubble, right? Yep. You had 08, 09. You had COVID, and yet if you would have stayed invested that whole time.
You had a taper tantrum in 2017 where the Fed was raising interest rates. And I think this is a case, too, where one of the values as financial advisors is, in some cases, either in our personal life or our personal investments, or just having been through all of this, right? We've either seen people get burned, or, in the tech bubble, I think probably some of us got burned on our, Yahoo stock is not coming back like it once was. We've seen people get burned or been burned ourselves. And so we've learned those lessons ourselves. And so we've gone through that pain for you. And that's why we're trying to, again, understand your concerns, understand that it's not fun to watch your portfolio go down every day, but we know to, hey, we've seen these pain points. We've lived through these pain points with our clients before, and that's why we're advocating what we're advocating.
Yeah, and I'll use another somewhat unrelated analogy, but the idea that when you go into the dentist to have some work done, right? They give you the shot of Novocaine, and they come back in a few minutes and they test it to see do you still feel pain? And then if you do, they walk away and they give it more time, right? Because they know that if you give it enough time, it works, and it's a matter of simply kind of looking at it and understanding that it's not that it can't fail, but the vast majority of the time, given enough time, it works. And I think that in a lot of cases is what's difficult for people, is understanding that if we give it enough time, it will work. And I think markets prove that out.
Yeah, and it's our human psychology. We're not trained to think of our, if you're 35 years old, Syl, 40 years old, your investment horizon is 50, 55 years.
Yes, right, right.
It's not today. It's not even, if you're drawing down, if you're 65 and you're drawing down, it's not even June, right? Oh, I've got to, take some money out in June. It's June of I'm trying to do, 2052.
Sure, right, right.
That's your time horizon. And I think, it's just from a psychological standpoint, it's hard for us to understand a lot of these things, right? And it's painful. Nobody likes to see those numbers go down.
Right.
Yeah. And I think an important point as well is a lot of people know that they're not supposed to sell, and they know that historically you look back and it would have been better to stay invested. But there's always a temptation to think that this time is going to be different, and that this crisis is not like anything else that we've seen before.
Right.
That this time is different, and that this time the market is going to collapse, and it's never going to come back because the world is ending. And, I think that's human psychology. And in some cases, there are, reasons why you might think that it is indeed different. And every crisis is different to some extent. But the reality is what we are afraid of when we think that way, it isn't that the world is going to end, because the world is not literally going to end. Nobody actually thinks that unless, the world gets, Earth gets hit by something out of space. I don't know.
And in that point, your investments won't.
At that
We're
point,
gonna have a hard time
at that point, it won't matter. But what people are afraid of is change.
Right.
And change happens all the time in markets. And what people are afraid of is dramatic changes that could happen in markets.
Right.
And the reality is that's not something that is going to, make us change your investment strategy. Because if you're a diversified investor, the reason you're a diversified investor to begin with is in order to be prepared for change, right? So if things are dramatically different 2 years from now compared to what they were last year,
right.
You're going to have to embrace it in some ways. And maybe what did great for the last 10 years is not what's going to do great in the next 10 years. And yes, maybe the world is going to look dramatically different. Maybe the countries that are doing well are going to be different. Maybe the industries and sectors that are doing well are going to be completely different. Maybe they'll look nothing alike. But if you were diversified, you're giving yourself the opportunity to capitalize on those changes. So the reason we invest the way we do is not to bet on this idea that nothing will change, but it's specifically to be ready for dramatic changes to happen.
Right.
We don't know where the changes are happening, but we know that there are going to be changes.
Yeah.
By the way, I'm going to drop a phrase here that will allow you to just seamlessly wrap up the podcast. When Syl was talking about, we know very well everything's going to be this, the market, we know not to sell, but just the same, there was a French psychoanalyst, Manoni, who was fond of saying, "Je sais bien, mais quand même." I know very well, but all the same. And so I think that's what we get in, in our mindset in a lot of cases.
And I think that you're right. That's a good way to close. And I think ultimately what we have to keep in mind too is that the market can absolutely, and does more time than people maybe won't even want to realize, the market can overreact itself, right? The market can sell off more than it should. The market can do things that it shouldn't do simply because it's what happens, right? And so I think that understanding that when things get crazy, right, it's not a matter of kind of how do we make it sane. We have to just let it kind of play out and then be where we need to be when that happens, so that we can best position ourselves for the rebound that inevitably comes after. So the last thing I'll say is lean on your advisor during these times. We want to hear from you. We want to hear phone calls, emails, if you have questions, if you're concerned. Let's talk about it. It's the best way to handle times like this. And maybe we can even discuss some ways to, maybe not redo your portfolio, but maybe there are small things that people can hear and just make themselves even just feel better for a day or a week that they hadn't thought about before. So we thank you for your time today.
Well, but just to jump in as well, in a lot of cases, this is where many people's advisors run and hide. And
this is true. Very true.
We want to talk to you. We don't want to run and hide. And if you have friends that are going through this and they can't track down their advisor, we're happy to chat.
No, that's a good point, Keith. I think now is when, from an advisor standpoint, now is when we do our heavy lifting, and we're happy to do it. And we want to do the heavy lifting for our clients and prospective clients if they're in a position where they're not getting what they want, or if they feel as though their concerns are falling on deaf ears with their current advisor. Have them give us a call. Let's talk about it, because maybe we're the kind of the different fit that just works better for them. So thanks again for your time, and we will look forward to another episode of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.